Nvidia has been the king of AI investing. But what if I told you there are 3 AI stocks growing even faster and most investors are barely paying attention? One is becoming the operating system for AI inside government agencies and Fortune 500 companies. Another provides the critical technology powering a massive AI data centers. And the third is a cloud computing company with a staggering $15 billion backlog and some of the biggest names in tech as customers. These stocks are Palantir, Astera Labs, and CoreWeave. And each could be one of the biggest AI winners of the next few years. In this video, I will show you exactly what these companies do, why their growth is exploding, and the risks investors need to know before buying. Let's start with Palantir. Palantir Technologies is a data analytics and AI software company founded in 2003. Its platform ingests, integrates, and analyzes massive data sets from disparate sources, and then presents actionable intelligence through software tools used by both government agencies and commercial enterprises. The company operates 2 primary product lines. Gotham is deployed by intelligence agencies and the U.S. military for mission planning, surveillance, and logistics. Foundry is the commercial version, used by enterprises in manufacturing, healthcare, finance, and energy to build operational data pipelines and AI-powered workflows. And its newest product, the Artificial Intelligence Platform, or AIP, is now the fastest growing offering in the company's history. Palantir's business model is centered on long-term, high-value contracts. Government contracts tend to be multi-year and sticky, often with embedded renewal clauses. Commercial contracts are expanding rapidly through a strategy Palantir calls boot camps, intensive hands-on workshops where enterprise customers build real AI use cases on AIP in just 5 days. But once a company builds its core operational workflows on Palantir, the switching cost becomes enormous. That's the moat. Let's go to the numbers. In Q1 2025, Palantir reported revenue of $884 million, a 39% year-over-year increase. That beat analyst consensus estimates by a meaningful margin. U.S. commercial revenue, the segment Wall Street watches most closely, surged 71% year-over-year to $255 million. U.S. government revenue grew 45% year-over-year to $373 million. Earnings per share came in at 0.13 on an adjusted basis, up significantly from 0.08 in the same quarter last year. The company has now posted positive GAAP net income for 8 consecutive quarters, which is a milestone that separates Palantir from the majority of high-growth software companies. For the full year 2025, Palantir raised its revenue guidance to a range of $3.89 billion to $3.90 billion, implying approximately 36% full-year revenue growth. That guidance raise came despite an already elevated baseline. Palantir's AIP platform is the company's central AI growth engine. AIP allows enterprises to deploy large language models and AI agents on top of their own proprietary, classified, or sensitive data, without that data ever leaving the company's infrastructure. That's a critical differentiator in regulated industries like healthcare, defense, and finance, where companies cannot send sensitive data to third-party AI providers. AIP's commercial customer count grew 39% year-over-year in Q1 2025, with the total U.S. commercial customer count reaching 139. The bootcamp strategy continues to convert high-intent prospects at an accelerating rate. Palantir's primary competitive advantage is its deep integration into mission-critical operations. Its software doesn't just sit at the edge of a workflow. It becomes the operating system for decision-making. That level of embedding creates structural lock-in. Secondarily, Palantir holds FedRAMP High and IL5 government security certifications that take years and tens of millions of dollars to achieve and that most commercial AI software companies do not have. Wall Street is divided on Palantir. The bull case is straightforward. AIP is in the early innings of commercial penetration, government spending on AI is accelerating, and the company's unit economics are improving rapidly. The bear case centers on valuation. Palantir trades at a significant premium to the software sector. As of mid-2025, the stock trades at roughly 70 to 80 times forward revenue, which leaves almost no margin of error if growth decelerates. The key risks: government contract concentration, execution risk in commercial scaling, and the premium valuation that requires sustained high growth to justify. Palantir is building a platform that sits between enterprise data and AI decision-making, a layer that enterprises and governments will depend on for the next decade. If AIP continues to penetrate the commercial market at its current trajectory, Palantir's revenue could compound at 30% plus annually through 2027. For investors with a multi-year time horizon, Palantir is one of the clearest plays on enterprise AI adoption in the public market. Second stock is Astera Labs, is a semiconductor connectivity company. If Nvidia's GPUs are the engines of AI data centers, Astera Labs makes the high-speed roads connecting those engines to the rest of the system. The company designs purpose-built connectivity chips. Its specifically retimers, smart cable modules, and memory controllers, that enable AI clusters to move data between GPUs, CPUs, memory modules, and storage at the speeds required for large-scale AI training and inference. This is not a flashy consumer-facing business. It is a deep infrastructure play inside every major AI data center being built right now. And because Astera Labs products are embedded at the hardware level inside hyperscaler infrastructure, they are invisible to most investors, which is exactly why this opportunity exists. Astera Labs sells its chips directly to cloud hyperscalers and original equipment manufacturers. Its primary customers include companies building out large-scale AI infrastructure, and the company has publicly confirmed design wins with several of the world's largest technology organizations. Revenue is driven by the volume of AI servers and clusters being deployed, which gives Astera Labs a direct correlation to AI capital expenditure spending by the hyperscalers. Astera Labs went public in March 2024, so its public financial history is relatively short, but the numbers are exceptional. In Q1 2025, the company reported revenue of $153.6 million, a 153% increase year over year. Let that number land. 153% revenue growth year over year in a single quarter. By comparison, Nvidia's most recent quarter came in at approximately 78% year-over-year revenue growth. Exceptional for a company of Nvidia's size, but less than half of Astera's growth rate. Gross margins came in at 77.3% on a non-GAAP basis in Q1 2025. Exceptional for a semiconductor company and reflective of Astera's fabless software-defined chip design model. The company has also turned cash flow positive, which is a significant milestone for a company that only went public 12 months ago. For Q2 2025, management guided revenue to approximately $160 million at the midpoint, representing continued sequential and year-over-year growth acceleration. The connectivity market inside AI data centers is expanding in direct proportion to AI compute spending. Every major hyperscaler, Microsoft, Google, Amazon, Meta, has announced multi-year AI infrastructure capital expenditure commitments totaling hundreds of billions of dollars. Each dollar spent on AI compute infrastructure creates demand for connectivity chips. Astera Labs is positioned at the center of this spending cycle. The PCIe retimer market alone, one of Astera's core product segments, is estimated to grow from under $1 billion in 2023 to over $4 billion by 2027. Add the CXL memory controller opportunity and smart cable modules, and Astera's total addressable market expands meaningfully beyond that. Astera Labs is essentially a pure-play AI infrastructure semiconductor company. Its entire product portfolio is designed for one purpose, making AI data centers faster and more efficient. Its Aries PCIe retimers are embedded in AI server platforms. Its Taurus smart cable modules enable the high-speed Ethernet connections between GPU clusters. Its Scorpio CXL memory controllers address the memory bandwidth bottleneck that becomes more critical as AI model sizes expand. The company has secured design wins at the platform level, meaning its chips are designed into the reference architectures used by major AI server manufacturers. Once embedded at the platform level, Astera's chips ship in volume every time a new server generation is deployed. Astera Labs operates in a narrow, highly specialized market. The engineering depth required to build chips that operate reliably at the speeds demanded by AI infrastructure creates a significant technical barrier to entry. The company has accumulated a portfolio of patents around its core connectivity technologies, and its early design wins with hyperscalers have created a competitive flywheel. More design wins produce more reference data, which makes winning the next design win easier. Incumbent competitors include Broadcom and Marvell, both of which are significantly larger. However, Astera's focus exclusively on AI connectivity allows it to innovate faster in this specific domain than a diversified semiconductor giant can. Analyst consensus for 2025 revenue sits around $650 million, implying continued triple-digit growth on a full-year basis. Several analysts have price targets implying 30% to 50% upside from current levels, citing the expansion of AI cluster deployments as the primary driver. The key risks are customer concentration. A significant portion of Astera's revenue is likely concentrated among a small number of hyperscaler customers. If any of those customers slows its AI infrastructure spending or shifts to an alternative connectivity solution, the impact would be material. Additionally, the company is small relative to its addressable market, which means execution risk is real. Astera Labs is a picks and shovels play on AI infrastructure, but a more specialized and less widely understood one than Nvidia. Every AI cluster being built today requires high-speed connectivity chips. As cluster sizes expand, from thousands of GPUs to tens of thousands to hundreds of thousands, the connectivity problem becomes exponentially more complex, and Astera's technology becomes more critical, not less. This is a company at the intersection of AI, capital expenditure acceleration, and semiconductor design innovation, and it is still largely underfollowed by the broader investment community. Third, stock is. CoreWeave is a specialized cloud computing company that was purpose-built for AI workloads. Unlike Amazon Web Services, Google Cloud, or Microsoft Azure, which are general-purpose cloud platforms, CoreWeave provides GPU-accelerated compute infrastructure optimized specifically for AI training and inference. It operates one of the largest Nvidia GPU clusters in the world outside of the hyperscalers themselves. The company went public in March 2025, and despite a choppy IPO environment, it has emerged as one of the most closely watched new public companies in the AI space, precisely because of the unique position it occupies. A cloud provider that does one thing, AI compute, and does it at scale. CoreWeave's business model is built on long-term compute contracts. Customers, primarily AI companies, research institutions, and enterprises building AI products, sign multi-year agreements to reserve GPU capacity. These are not spot contracts. They are committed take-or-pay agreements that give CoreWeave predictable recurring revenue. The company then deploys that capital to build out GPU data center capacity. This model creates a significant revenue visibility advantage. CoreWeave has disclosed a remaining performance obligation, essentially contracted future revenue, of approximately $15.1 billion as of early 2025. That number represents one of the largest revenue backlogs of any newly public technology company in recent history. CoreWeave's revenue growth is extraordinary by any standard. In 2024, the company reported full-year revenue of $1.92 billion, a 737% increase from $228 million in 2023. In Q1 2025, revenue came in at $981.6 million, a 420% year-over-year increase, and a near doubling from Q4 2024. The company is not yet GAAP profitable, a function of the massive capital investment required to build GPU data center infrastructure. However, adjusted EBITDA margins are expanding, and the company's revenue trajectory gives it a clear path to profitability as its infrastructure base scales relative to its operating costs. For full year 2025, CoreWeave guided to revenue of $4.9 billion to $5.1 billion at the midpoint, implying approximately 160% year-over-year revenue growth on top of 2024's already extraordinary baseline. CoreWeave's anchor customer is Microsoft, which has signed a major multi-year contract to use CoreWeave's GPU infrastructure for its AI and cloud services. Microsoft's relationship is significant for two reasons. It provides revenue certainty, and it serves as a validation signal for other enterprise customers evaluating CoreWeave as a compute partner. Beyond Microsoft, CoreWeave has disclosed contracts with major AI companies and research organizations. OpenAI has also been identified as a CoreWeave customer, the company training. The models that power ChatGPT is, in part, doing so on CoreWeave's infrastructure. That's a meaningful endorsement of the platform's reliability and performance at scale. CoreWeave is perhaps the most direct AI infrastructure play in the public market today. Its entire revenue base is generated by companies and organizations training and deploying AI models. Every incremental dollar spent on AI compute globally is a potential revenue opportunity for CoreWeave. The company holds approximately 250,000 Nvidia GPUs, including H100 and H200 chips, the most in-demand AI accelerators on the planet. As demand for AI inference, running AI models in production, grows alongside training workloads, CoreWeave's infrastructure becomes increasingly valuable. Inference demand is particularly important because it is continuous rather than episodic, which supports a more recurring, predictable revenue model over time. CoreWeave's primary advantage is focus. The major hyperscalers are building AI compute capacity, but they are also building databases, storage, networking, software as a service, and dozens of other products. CoreWeave does one thing. That focus has allowed it to optimize its data center architecture, its software stack, and its customer service model specifically for AI workloads. In practical terms, CoreWeave can provision GPU capacity faster, at higher density, and with lower latency for AI-specific workloads than a general-purpose cloud provider. The $15 billion revenue backlog is also a structural advantage. It gives the company the capital certainty to continue investing aggressively in infrastructure while competitors are still navigating demand uncertainty. Because CoreWeave only recently went public, sell-side coverage is still being established. Early analyst price targets have ranged from the mid-50s to above $90 per share, reflecting significant uncertainty around the rate of backlog conversion and the pace of margin expansion. The risks for CoreWeave are material, and investors should not ignore them. Customer concentration is the most significant. Microsoft alone represents a disproportionate share of revenue, and any renegotiation, reduction, or cancellation of that relationship would be severely damaging. CoreWeave is carrying substantial debt taken on to finance its data center build-out. Interest expense is a real cost that puts pressure on the path to profitability. And there is competitive risk. If the hyperscalers decide to aggressively price their own GPU cloud offerings to compete with CoreWeave, margin compression could be rapid. CoreWeave is a high-risk, high-reward proposition. The bull case is that AI compute demand will continue to outpace supply for the foreseeable future, that CoreWeave's infrastructure advantage and locked-in backlog will allow it to grow into one of the most important cloud platforms of the AI era, and that its margins will expand significantly as its revenue base scales. The bear case is that hyperscaler competition, customer concentration, and debt load create a fragile financial profile that could unravel if AI spending decelerates. For investors with high risk tolerance and a long time horizon, CoreWeave is one of the most asymmetric opportunities in the public AI infrastructure space. But it requires careful position sizing and ongoing monitoring of its customer relationships and balance sheet. If this breakdown gave you a new perspective on where AI growth is actually happening, beyond the stocks that dominate the headlines, hit the like button and subscribe so you don't miss our next deep dive. Drop your thoughts in the comments. Which of these three do you think has the best risk-reward setup right now? Palantir, Astera Labs, or CoreWeave? We read every comment. And as always, do your own research, understand the risks, and size your positions accordingly. See you in the next one.